All right, hello guys, and glad to have you on board again today, like we were used to in 2022, and we'll keep on doing this in 2023. We'll have a look once a week, and generally around Wednesday, at more shorter-term time frames, basically still following up with what we do each and every week, still in TradingView. Available generally on Monday, the weekly reviews, which means in these weekly reviews we update the low-risk timeframes, which are generally occurring in these larger scale timescales like dailies, weeklies, and monthlies. And in that perspective, we just keep on updating these week after week with consistency. And remember, TradingView, I cannot delete anything, so that's kind of a track record of all my ongoing strategies, because as always, I speak where my money is. So that's the thing. And on those weekly intraday updates, what we do care about is on those bigger timescales, low risk strategies, we go into shorter time frames intraday. So we're going to have a look at 15 minutes, 1 hour, 4-hour charts, and we tend to have a look at where the flow trading can happen. Meaning basically, when you've highlighted the low risk strategy, and this is not something you can decide, this is the market deciding which time frame it is on. And for example, in the S&P 500, on those weekly updates, we say that the weekly chart is actually the one in which the low risk strategies are playing, though that means we have flow trading, which is generally going to occur 3 time frames below. So this is basically, we're going to scroll down 3 steps below. That gives us a 1-hour chart time frame probability to get flow trading. What flow trading is, it's just no more than prices moving in a trending fashion without nearly being the primary trend. So this is just like sub-time frame trends that we can follow with different types of strategy, mostly based on volatility derivatives, aka Bollinger Bands and moving averages. And basically what we're going to be doing in here is looking at prices shifting away from the moving averages. So basically, you know that a range is when the moving average is inside the context, and a trend, aka primary trend or flow or anything else that looks like a directional trend move, is when the moving average is standing away from the context. So basically in here you got a portion of a flow, which means flow trading has been happening in here. Same thing goes in here, flow trading was there, okay? So that's what we look at in those weekly updates, in those intra-day updates each and every Wednesday or so. So the thing is that this is part of the reviewed trading lessons series that's going to be released earlier this year as well. I'm going to start recording this ASAP. Okay, so you'll have all the strategies about that. But remember one very important thing. You can't do flow trading, meaning shorter term time frame volatility trading, until you have assessed in which time frame and what context is the low risk strategy, and that's really, really crucial for us. Okay, so TLDR in here, S&P 500 low risk strategy is on the weekly, though the flow trading is tradable on H1. So what we want to do now is to create and have sign of a bullish flow, because we have bullish signals on the weekly chart, suggesting normally the bulls should gain strength more than the bears in this market. So for now, we see that the bears have been scoring some significant points. You see the moving average is standing right next to the resistance context, which means if I am wrong and if the bears take it over, I'm going to have to take a stop loss. I'm buying the market right now. And if I am wrong with that assumption, that means the bears win, I take a stop loss and we move on to another trade. It's just as simple as it is. Having a risk limitation on the bigger time frame certainly doesn't predict the future. It's just reducing the risk. So for now, my lower risk strategy tells me upside potential is supposed to take over. So I would like to be a buyer, and if I get it wrong, stop loss, move on to another trade. Okay, so now, like we stated, the bears kind of have some strength. So the first things we need to do now is to fuck up that strength. So I think as a bull, my goal is to fuck up the bears. Not necessarily say I'm going to go straight up to targets. That's not the thing. The market specifically will go ups and downs, cycles and stuff like that. But first of all, I need to reverse the bear trend, meaning that I need to see prices trading above the moving average, and I need to reverse that bearish context. Though this is the area which I think the bulls should be headed to. And if we do such a thing, I certainly don't see any such a thing as a bull flow now. The moving average is bearish and the context as well. So we don't have any bull strength. We need to build it up. Though in that perspective, you need to understand what what flow trading does. Flow trading generally breaks on the 1-to-1 ratios type of stuff. That means if we succeed taking a point in that game, okay, there's no more than that. It's just scoring a goal in a football party, okay? That's really the way it is, nothing more than that. It hardly will go over 1-to-1 ratio. So I think the best the Bulls can score now is to get us right up to 39.80 or so. This is the area in which I personally think we'll do a pretty decent job. We'll sustain prices breaking the moving average and reversing the context. So that is my goal for the days to come, succeeding in breaking 1-to-1 ratio, reaching 39.80, and by that point I will succeed on partial profit taking and letting it go with those first trades. Okay, that's really the way it is. Then flow trading means the only way in which I will be able to target more than a 1-to-1 ratio is going to be basically on Bollinger Bands or moving averages. Though when you have a flow, it generally follows a couple of sequences that can vary quite significantly because they're based on volatility. And remember, volatility is just no more than the broker's game. It's either opening or closing out the volatility by just allowing more liquidity or restraining liquidity flowing into the exchanges. And that is market maker's job, certainly not yours. So you don't control the game. It's not low risk strategy. It's just basically volatility arbitraging, and it is a complicated mess. So in here, you don't want to play the complicated game. The strategy has to be very simple, and it is. Though the thing is, when you get a first flow, always try to buy the moving average afterwards. Okay, that's the way it is. Try to buy the moving average. If you get stopped out of this area, buy the Bollinger Bands. And of course, if you get stopped out 2 times, that means the bears have it in control. You've lost. I mean, you're in the wrong direction, bro. Just move on, okay? Don't try to fight against this. When the second flow steps in, which is basically the market rebouncing out of the moving average area, but at a later stage, with lesser probabilities, the Bollinger Bands, normally the price should break the previous high point. Remember, flow is just no more than the Dow fucking theory, higher highs, higher lows, and that's basically it. So as long as you created a higher low, either it was from the moving average or the Bollinger Bands, prices should retrace right up to the previous high point. If you do, then your flow trade is confirmed. You can take your trade at break even and let it ride. Okay, you let it ride until you get a third range boundary. When the market is building a third range boundary, either here or there, take your fucking profits and let the market digest. The second part of the flow is now terminated, and you can expect eventually a third one, but generally the third one will retrace to the Bollinger Band. So this is where I started buying back again on the S&P 500. I bought in here, and bought in here. Okay, that's really the way it is. I'm buying at the derivatives, at the volatility derivatives, so basically the Bollinger Band. And now the third flow should start to occur. The third flow has to do exactly like before. I need to have a rising moving average and a rising context, and I need to see the context stepping above the moving average. So for now, I've got quite the opposite. Like I said, we have a bearish context and a bearish moving average. So that's the reason why I said first we need to score some points until we succeed, reversing that moving average, reversing this context until both of them are bullish, and up until the context steps out of the moving average, which would be the sign that my third flow is clearly going on. Another metric is breaking the previous high point. So this third flow has a target that is building a higher low point. How high is it going to go? I goddamn don't know. You don't anticipate that. On flow trading, you don't know anything about your target. All you know is that you're going to be bullish until there is a third range boundary, and that one you're going to take your profits on. And really, you make it easy like that. When you've traded 3 flows in one direction, you don't count for any 4th or 5th ones. It's just 3 times in the same direction, and then you let go with that flow. You let the bears kind of take it over again, contract, congest, and then normally another step flow could eventually occur. But you need to let the bears score some points as well. That's the way it is with trading volatility. Though, of course, I just made the TLDR in here. It's a bit more complicated than that, but there's not so many complicated stuff to learn, okay? All of this will be in the updated trading lessons, but it's just something that I wanted to share with you guys because I've explained it in multiple occasions in French part of this channel, but not necessarily for you guys in English. So don't worry about it. Flow trading is going to be absolutely easy to understand. I'll put it into the Prezi as well, and it will be included in your trading lessons. But remember one thing, there's no flow trading out of random chaotic stuff, okay? You do this absolutely 3 time frames below the low risk strategy, okay? That's the way it is. That means you cannot do flow trading if you haven't figured out the low risk strategy. That's really the way it is. First the low risk, and then if you want to trade shorter term time frames, you can do flow tradings 3 time frames below. That's the way it is. All right, so basically this is what we have now. We need to wait to eventually get a bullish flow in the S&P 500, and as we don't for now, it's all about regaining strength step by step until we get a rising moving average and a rising context, which should favor the bulls and let the third flow build itself. Target is breaking previous all-time highs and maintaining prices above the previous low point. If we go out there, I'm out, bears won, and I'll just move on to another trade. That's the way it is. Now for crypto, same thing happens in here, okay? That's the thing. The low risk strategy is in the weekly charts. Okay, we have assessed as well that could be signs that it eventually would be on the monthly, but as we can see, the monthly contexts are just 4 context boxes, and boy, the last one has been pretty broken. So I would say this is kind of somewhere in between weekly and monthly, and in that perspective, we know the flow tradings will be between H1 and H4. Until then, well, H1 doesn't show that much of a flow, but there's one in here. Remember, what we look for is a bull flow because the low risk strategy is bullish in the weekly chart time frame, though we favor bull flows, and if bear flows occur, we just take stop losses. That's the way it is, okay? It means you can be wrong, and if you are, you take a stop loss and you move on to another trade. So in here, I'm just looking at moments in which the prices have stepped above a rising moving average. It's just as simple as it is. This was a bull flow, this was as well. And that's basically it. Anytime it happens, I trigger again. Remember, I was bullish in Ethereum back then, and I took a stop loss. Just basically the way it is. Oh, actually, it took some profits, remember? Oh, third range boundary, I'm out. Okay? So that's the way it is. Same thing goes in here. You reverse my context, okay, I take the profits there. It's really the way it is. It isn't that complicated. All right, so first flow was in here. Like I said, the second flow starts after the third range boundary on the moving average. I did buy this area. Okay, then I got stopped out. The market broke, so I was at break even, and I got stopped out in here. No loss. But remember what I said, there are 2 risk limitation areas, the moving average and the Bollinger Band. So what do you think I did out there? I bought again. That's really the way it is. Stopped at break even in the first trade, back in on the Bollinger Band, as long as we have a higher low point. So TLDR, you know where my stop loss is. Okay, until then, what do? I have a bearish moving average with a bearish context. Now the context has reversed to bullish. Second thing, I'd like the moving average to do as well. I would like to see as well the rising context rising above the moving average, which would be a sign that another flow is starting to occur. I also pay attention to the previous resistance, which means my next flow needs to break above this level, push prices above the moving average, and I'll follow that thing until third range boundary. When the third range boundary occurs, if it is in here or in here, I don't give a fuck. I'll be bullish until there is a third range boundary. When there's a third range boundary, I get the fuck out of here and take my profits. And then I'll wait for what? For prices to retrace to the lower Bollinger Band. Will I buy again? That's really the way it is. As you can see, it's the same old pattern, which is easy to understand. It repeats itself consistently. Sometimes it fails, you take a stop loss, but you go over again. It's really the way it is. Shorter term time frame trading isn't complicated until you understand that it only works if you're in the appropriate time frame. Because I haven't decided that, well, I'm going to do it on the H1 time frame. Some other assets have monthly risk limitations. And in that perspective, the flows will be traded in 4 hour and certainly not in H1 time frame. So if you do it like, well, it's easy, I can do it in every asset and stuff like that. No, it isn't, because assets change their reference time frame over time. For now, most of the assets that we do follow in those schemes, whether that is cryptocurrencies or general S&P 500, they tend to have the same time frames. But don't take it for granted. Over time, these things will significantly vary. And when the time frame of the low risk strategy varies, the time frame of the flows varies as well. That's the way it is. And remember, if you do more than 3 flows at a time, you're doing shit. Once you've scored 3 points, let some points for the bears. The market in a flow trading mode cannot go up only. It never happens that way. And last but not least, when you're in a low risk strategy, you never trade against it. Okay, that means when we are in a low risk bullish weekly supportive area, you don't sell. That also means that on the weekly chart time frame, there is a resistance area. Okay, there is obviously a selling area on the weekly chart. When you get into that selling area, if you are dumb enough to bull flow trade, you're gonna have some troubles. Okay, so no buying activity on the low risk selling activity. Okay, and no selling activity on the flow trading when you're in a bullish low risk activity area. Okay, it's really the way it is. If you take those simple rules, you will be successfully trading in shorter term time frames. But TLDR, if you don't know how to find a low risk strategy time frame, this don't work. Now this is how it is. Trading volatility might sound very simple, and it actually is. But if you don't do it in the right time frame, it's really a cutthroat job. And I've seen so many people saying, yeah, trade the Bollinger Bands, it's really easy. Yes, like I said, it is, but it requires a little bit more mastering than just trading Bollinger Bands randomly. Okay? It can be done on one time frame, and this time frame changes over time. And if you don't know how to adapt, well, you'll see these strategies are pretty much not gaining so much that you don't make so much money with volatility trading unless you know which time frame to trade on. And I just gave you one way to do it. Of course, this is just one out of many ways to trade. There are so many strategies out there, mine is just one another, okay? So I'm not saying I found out the trick and everyone else is stupid. It's just not that way. It's just that I know something that works. I've been testing this for years. I can account for this one to work. I've seen many other traders who are basically plain full liars, but that's also a topic for another day. Until then, well, I wish you guys learned something today. We'll do a full review of this in the trading lessons, in the Prezi, but until then, we're going to repeat that as well each and every week because that's what we're going to be doing now. Okay, Monday is the weekly update on the larger time frames, the low risk strategies, and basically that, and we cover this in TradingView each and every week around Mondays. And each and every Wednesday, we do look at intraday time frames, aka 15 minutes, 1 hour, 4 hour, try to figure out if we have flow trading available. Okay, that's pretty much all about it, guys. See you later.